Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist at Wealth Press. Today is Wednesday. It's January 19th. The first month of 2022 is two-thirds behind us, and it feels like New Year's. It feels like Christmas 2021 to me still. I'm still back in 2020. I'm still actually back in 2018, if you want to know the truth, before all this COVID craziness started. Anyhow, it's about 7:53. The market's going to open up in about an hour and, let's see here, 37 minutes or so to be exact. We're a little bit higher, which is not surprising after the meltdown we saw yesterday. Holy moly, what a turndown. But I think the worst is behind us. I honestly do. I want to show you some indicators that are pointing to upside, and I think you'll be pleased with what you're seeing. And most importantly, look, the truth of the matter is, nobody has a crystal ball. Well, I do have one at work, but you know what I mean. Nobody has a crystal ball. But the truth of the matter is, markets are reacting on certain factors like interest rates right now. And I think it's a little bit overdone, and I'll show you exactly what I'm talking about in a few minutes. But so far, things are looking stable. There's no major news coming out. The biggest factor is earnings. And so far, the numbers are looking solid. There is some, it's kind of early. We've only had about 30 S&P members report. But so far, I think about 80% are beating earnings per share estimates, and close to 80 or 85% are beating the revenue. So the numbers are solid. Looking at the bond market now, if you want to know why the market reacted the way it did, is because, look at this. There's a huge correlation between tech and consumer discretionary stocks and bond prices. When bonds go higher, usually consumer stocks go higher because interest rates go lower. When bonds go lower, that means consumer stocks, retail stocks, tech stocks go lower because interest rates are going higher. Remember, when bonds are going lower, interest rates are going higher. When bonds are going higher, interest rates are going lower. So there's an inverse relationship between them. But at this point, not only are we hitting the multi-day low, but RSI is so overdone, it's just ridiculous at this point. We have shaken out just about everybody and their mother at this point. And I think the bond market is ready to go higher. If the bond market's ready to go higher, it means there's a good chance we'll get a relief rally from the stock market. So you've got to pay very close attention to the bond market at these levels. But we literally went from 155 to 140. We've lost literally 10% of the value of the bond market in, let's see here, 12/6, in less than 2 months. In less than 2 months. Matter of fact, in 5 weeks, 5-6 weeks. That's too much too fast. So I think the bond market's going to go to the 146, 147 level. The bottom line is bonds are way overdone to the downside right now. And momentum indicators are confirming them. We all know interest rates are going to go higher, but this is way too much too fast. Way too much too fast. And it's time for bonds to go higher. At these levels, I may be even a buyer of the bond market. But the bottom line is, watch the bond market for a rally, maybe to the 148, 150 level. This is a shakeout if I've ever seen one. And again, with bonds going higher, we may see higher prices. Russell 2000. Notice this has been the weakest sector, but I want to show you something. We have divergence here. We have momentum levels going higher on the RSI and price levels going lower. Typically, when momentum levels can't give up anymore, that's the end of a downside. So I'm expecting upside from the stock market at these levels right now. I think the stock market's going to go higher, and I think it'll take bonds with them. Also, this is now we're looking at the NASDAQ 100. Now we're looking at several different things, and they're telling us the same thing. So it's really important. Look at the number of stocks in the NASDAQ 100 trading below the 50-day moving average. We're at 25%, folks. So let's look at it historically. Over 10 years, this is 10 years, okay? This is monthly. We are now, let's see, 1 time, 2 time, 3, 4, 5, 6, 7 times we've been down to this level. Look at where we're at. Are we going to have a crash from these levels? I hardly think so. I hardly think so. I think possibly, we'll cool down a little bit more and start moving higher. But as far as I'm concerned, that's about it. We're at the last leg of a shakeout. We're near the bottom, not near the top. When you look at it on a monthly basis, when you look at it on a daily basis, and when you look at it on a weekly basis, We're just, this is COVID right here. This is that COVID meltdown. But even so, look, we went whoop and then went right back up. Most of the time we go to this level, we really do look like we're overdone at this point. Now let's look at put to call ratio. We're above 1, another indicator that the market's overdone. So the bond market is overdone. The Russell is overdone in terms of divergence. The NASDAQ 100 is pulling back to the 20-day, to the number of stocks trading above the 50-day moving average to the 20th level. And put the call ratio is above 1, which is telling me the market is overdone. So I believe we're going to see maybe some choppiness, maybe some more congestion, but I think overall we're going to see a bullish market over the next few sessions, at least the next few sessions. Matter of fact, we're right between the 50-day and the 200-day moving average. But if you look at the QQQ, we are already near the 200-day moving average, and I honestly just don't see too much downside from the current levels. I think it's up to the bond market and up to earnings to pull us out of there, but right now things are looking a little bit better. Also, something else I wanted to show you. If you look at Stock Fetcher here, and if you look at my 11 sectors, cumulatively, energy, consumer, basic material, financial, real estate, speculative is nowhere on here. It's down here finally. Tech and consumer discretionary, but look at it on a monthly basis. We're all the way down here. So I don't think there's that much more to go. We've achieved the sector rotation, and now I think it's going to go higher. I'm actually in the position where I think I'm going to buy bonds for all the programs as a bonus position over the next few sessions. But as far as global economy, let's talk about that. Global shares mostly fell in cautious trading on Wednesday. Technology shares led decline on Tuesday. Losses in global indexes have mounted this month as rising inflation and the pandemic-related surge has caused investors to take caution. The Federal Reserve and other central banks are under pressure to curb inflation after consumer broad prices rose last month at the fastest pace in nearly 40 years. At the same time, the U.S. job market bounced back, leaving unemployment at a pandemic low. So we're having a little bit of a it's happening. We are finally starting to gain some stability if we can balance out from these levels. That gives the Fed more leeway to rein in the unprecedented support it provided the economy since the pandemic because unemployment rates are so low. Sorry, I'm going kind of fast through this. Market players are watching for the latest earnings releases. Bank of America, United Health, United Airlines reporting today. Earnings of American Airlines, Union Pacific, and Netflix are due tomorrow. So we've got a couple of big days. But today's Wednesday, and on Wednesday, I always give you guys my top stocks. So I think tech is going to start making a comeback. So I'm liking Apple right now. I'm really liking Apple. I like it at these levels right here. We're approaching the 50-day moving average. I think we're going to bounce back. If you look at the 2-day RSI, which is a good short-term indicator, we're way overdone. And if you're an options trader, I would go for, let's see here, January, February, March, April, May, expiration. You can probably go to the 170, 175 strike price right around here. So what I would do is, and you may have to rewatch this video for all the details, I would put my stop loss right at the 160-ish level and ride this thing till it makes a swing high to about the 184 level. That's what I like for the upside. Now for the downside, Charles River Laboratories. I think this is going to come down all the way to the base. I don't think there's any good reason for this stock to go up. If it breaks above this 369 level, I would get out. Otherwise, I would just ride it all the way down. In terms of options, let's see what we could find. Let's see. In terms of puts, here we go. We had a put yesterday. Ooh, 370. I would go, it's a little expensive. You may want to do a spread. You may want to do a spread on the put side by, let's see here. You can go ahead and buy the 340, right? I know it's a little expensive, but you can buy the 340 and you could sell the 310. That would give you a good 30-point leeway. And it would cost you about $10. but I like the stock to the short side, CRL, River Laboratories. I think it's going to make a new swing low. So again, just to give you a review, NASDAQ looks like it's bottomed out. Bond market looks like it's bottomed out. The Russell looks like it's diverging like crazy. The NASDAQ 100 looks like it's completely almost to the bottom. Put the call ratio is overbought. And the heat map is still very, very defensive, but I think that's going to change over the next few sessions. And I'm going to go ahead and initiate a bonus trade for bond for all of my programs right now. So, because I just think bonds are crazy overdone right now. Now, before I let you go, I've got something very, very important for you. I just held a training session, right? We went over, just yesterday, we went over how to position ourselves for the current upcoming phase of the economic cycle. We talked about the Fed effect and the impact on sector rotation moving forward. I gave you my number one sector play for the next 6 months and my top stock. Folks, it was all meat and potatoes. There was no fancy schmancy talk about buying new cars and how rich everybody is. None of that. It's all meat and potatoes. Click the link below and learn more about alpha rotation and learn what it can do for you in this challenging market. And as always, make sure to like this video, subscribe to this channel. If you're watching on YouTube, stay ahead of this crazy market. Be the first to be notified when we post my next video. Tomorrow, we're going to talk about top ETF and option pick. And follow the link below. Check out alpha rotation. This is my bread and butter strategy for ETFs. It's got over 70% win rate on over 1,000 trades going back 12 years. You guys, you do not want to miss out. Follow the link below this video. Do it now and have an amazing day. And send me some letters if you're getting some value out of this. Support@marketgeeks.com. Bye. I'll see you tomorrow. Bye, guys.